Many borrowers are very interested to understand where mortgage rates are headed. Many are reading the headlines that the Fed is cutting rates and they're expecting mortgage rates to reflect that, and they just aren't. So I'm going to explain why in this video, and I'm going to give you the forecast of what rates will be in 2025 so you can plan accordingly. As a reminder, I'm Mike Thornton. I'm a realtor here in the western suburbs of Chicago. If you're looking to make a move here or just want to talk shop, talk real estate, reach out to us. Our information's in the description below. So let's talk about where we are today currently here in October with mortgage rates. They sit about 7% for a fixed 30-year mortgage. That's with almost perfect credit and a 20 to 25% down payment. That is up almost 3/4 of a point from where they were about a month ago. And many consumers are confused and wondering why, especially because the Fed just cut the Fed funds rate by 0.5 point, which was more than expected. And they thought mortgage rates would go down accordingly. Now, do mortgage rates and the Fed funds rate tend to move in parallel over time? Sure, somewhat. There's a typical spread about 2 to 2.5 points between the Fed funds rate and where mortgage rates tend to fall. They are not directly correlated, and actually mortgage rates actually tie back to the 10-year treasury much more than the Fed funds rate. However, you would expect over time that they kind of fall in line together and have that typical spread. So one thing to understand is that spread is greater today than it's ever been. That could be because of market volatility, the markets, not understanding where we're going from an economic standpoint, inflation being sticky, not getting down to that 2% target that the Fed wants. However, let's just assume that we get some sort of stability. Inflation looks like it's under control. You get past the election, there's a little bit of stability in the markets. You could see that spread come down a little bit, which could bring rates down without any additional Fed cuts. Now, the Fed has signaled that they will continue cuts into 2025. However, a lot of that is already built into the pricing of mortgage rates. So where do we go from here? Well, I think it's important to look at where the key forecasters have forecasted rates to be in 2025, and then we can look at what's likely to happen based on that. So you have Goldman Sachs that believes that mortgage rates will not get below 6% in 2025. So the bad news is you're not going to see rates in the 3s or 4s, in my opinion, ever again. However, that is about a point down from where we are today, so there is some relief from that standpoint. Now, there's other forecasters such as MBA that believes that we will see rates as low as 5.9%. You have Fannie Mae that believes that you could see rates as low as 5.7%. And then you have Wells Fargo most aggressively thinking that rates could get down to about 5.5 at the end of next year. So what do you do with this information? Well, in my opinion, as a real estate professional, it's really tough to time mortgage rates, try to time the market, and it's just really a futile exercise to try to do that. Now, the good news is that you have the opportunity, if you still qualify down the road, to refinance if that benefit presents itself. It's not automatic. It's not just as simple as date the rate, as some people would say, when that was a popular saying. But, it is something that's possible for you if your financial position is in a similar spot and you qualify for a loan at that given moment in time. Now, if you lock into something today and the opposite happens, mortgage rates go up, obviously there's nothing hurt there. You've locked in a lower rate. That's good news. So don't try to time the rates. At least that's my opinion. If they go down, great. Try to refinance. If they go up, congratulations, you locked in a lower rate. Now, with that said, you obviously need to afford, what that rate is on day one. That's the key. Never lock in a rate with a payment that you can't afford. That's not what we're trying to do here. However, it is projected that you should see some relief with mortgage rates going into next year. Now, what does that mean for home prices? Well, interestingly enough, you had home prices appreciating in many areas of the country, 8, 10, 12%, leading into the midpoint of 2022, where the Fed basically jacked up rates, mortgage rates responded, and you saw mortgage rates basically double overnight. And they would have thought that that would basically free up a ton of inventory because demand would go down and nobody would want a house, and that you'd see inventory climb, putting relief on home prices and therefore helping affordability in the long term. However, the inverse happened that created this lock-in effect where everybody that had a mortgage rate already locked in didn't want to make a move because they didn't want to trade their 3% mortgage rate into a 7.5. And so basically it created this lock-in effect, whereas nobody wanted to move. Velocity of sales went way down. Inventory did not jump at all. It actually went down in many areas. And you had now an even bigger issue where you had even worse affordability as home prices continued to move upwards as they were previously to that. And now the mortgage or the cost of financing went through the roof. And so your affordability tanked. So now we're in this position where we have this systemic problem of home prices moving up a little higher than they should, which is not really sustainable. You should see, appreciation in the 1, 2, 3, 4%. That's something we probably could handle as consumers, but to have 4 years in a row of 8 to 12% appreciation, that obviously kills affordability for many buyers. So that is the challenge in today's market, is how do you increase that turnover of homes, give buyers more opportunity, have less competition on each home. And so when you look at policies that would facilitate that, we're not looking really for policies that increase demand. You're really looking for policies that could increase supply. So how do we create affordable housing? How do we incent builders to build homes that are around the median price point? Because I know builders in our area in the western suburbs really struggle to make money unless they're building a luxury home. So how do we incent those people to do that? How do we take advantage of different asset classes in real estate, and how do we convert them to housing? Those are the type of conversations I think are really valuable, not just, here's down payment assistance, because all that does is increase demand in an equation where demand already exceeds supply, and that is really the issue. We want to get back to more sustainable appreciation. We don't want home prices necessarily going down. However, we don't need them going up as fast as they are. So just to recap, rates are about 7 now. The projections are they could get as low as 5.5, as high as, let's just call it 6.25, and that is a projection leading into next year. They do believe that will steadily decrease as the year goes on, and so those lowest rates that they all reference are Q4 2025 rates. Hope this was helpful for you as you plan potentially a move. If you are thinking about making a move to the western suburbs, let's connect. Information's in the description. Hope you enjoyed it. Talk to you next time.